Hi there everyone. I wanted to get back to our variance example that we had in class on Friday. I've already done the video for direct material. That's the one that has the twist, but I wanted to follow up with this one on direct labor because it shows you that there is no inventory effect on the labor variances. So what I put together again for you is just this clipped out that comprehensive problem. You're focused in this case on the direct labor piece. So we can finish out our Latois based on that. So the starting point, as always in these things, is the test in this case that I actually performed. So for this problem, that'll be the 250, and as you know, the 2250 is the same. So that has to be equal. All right. Then I know from my standards table that I have 5 direct labor hour, and my pay rate is 10. So as a result, I can finish out the rest with a straight multiplication and then another straight multiplication. Remember, this is dollars. Okay. Now, the other part that we have left is the side of the actual. And so in this case, they tell you that you used 850 direct labor hours, so that goes here. Now, one of the things you're used to is sometimes I could give you this actual resources per finished unit. So it's a multiplication. Here you didn't have to worry about that multiplication. And then the pay rate was 1150. And as a result, you got a total of 9775. As we said in the last video, this section in gray is what I would call the golden rectangle. That has all the information you need now to be able to do the price and quantity variance. So if we're going to do the price variance, okay, what I need to know is my actual quantity, and that was 850. Okay, 850, and then times my standard price, which was the $10, minus the actual price, $11.50. So this is by definition going to be a bad thing, to the tune of 12.75. Bad thing. Okay, so at that point we can go in and do the quantity variance. We know it's the standard price, the $10, times our standard quantity, 1125, subtract the actual quantity, 850. This is going to be a good thing, right? Because we use less than expected. And so that comes in at 2750, and that's a good thing. All right. And so what you'll notice is if I add these two numbers together, if I add the two variances together, I get 1475, and that's a good thing. But that's a net number of the two variances. That 1475 is also the difference between these. Okay. Now, the thing I pointed out when we were doing the material, this cannot be done. You can't do this when it comes to material because the variances are calculated at different times. So in the materials, the price variance is calculated at the time of purchase, and the quantity variance is calculated at the time of usage. Because they're at different time periods, you can't add them to get the difference. Because there's no inventory effect, these two variances for labor happen at the same time. So because of that, I can net them, and I can reconcile the difference between my flexible budget and my actual budget. Anyway, I think it's important that you compare this to the materials video that I did in hopes that you can clarify the differences. All right, take care. I'll hope this works for you.